Welcome to KonichiValue. Today I'm going to show you how I find the most undervalued stocks in Japan. I'm going to first show you what tools I use. I'm going to show you how I screen a company. And then lastly, I'm going to go deep into one company that looks undervalued on paper to see if it's actually undervalued enough to do a thorough analysis on. So please get excited and let's go. The goal of this video is to show you how you can do the same, and also my way of thinking and my way of picking the right stocks to analyze and go deeper in. So, to my help, I have a lot of tools, but first and foremost, I'm using the magic formula created by Joel Greenblatt. And I'm also inspired by the Swedish Investor, a really good YouTuber who actually created a guide how to screen really valuable stocks in the US with the help of the magic formula and his own way of adjusting the formula. So to start easy, these are the criteria that the magic formula by Joel Greenblatt. First of all, I just want to say an amazing investor that has gotten some of the highest return on his investments of any investors of all time. So first, it's growth, so how fast the company is growing. Then it's ROIC, or return on invested capital. So that's basically how much money investors put in comparison to how much money the company generates. And it's a percentage number. And then EV/EBIT, that's enterprise value through earnings before interest and taxes. And it's basically another way to show the company's valuation, if it's under or overvalued, than using the PE, price to earnings ratio. And a lot of professional investors use this one instead. But I prefer PE a lot of times, but this one is what Joel Greenblatt uses, and Warren Buffett, to be fair. So it's what I'm going to use here. Lastly, it's insider activities. So insiders are anyone working in the companies, but especially the CEO, CFO, etc. And if they're buying, that's a high indication that the company is going to do well in the future. And this weighing is actually something I've taken from the Swedish Investor. So as you can see here, growth, ROIC, 20% each is the way of the total score I'm going to give the company. And then EV/EBIT, or another version of the price to earnings ratio, really high because we want to find undervalued companies. And then insider activity, also important. It's another 20% of the weighing of the total score. And here we focus on efficiency in valuation and insider confidence. And the objective here is to find companies that, first of all, are really strong on paper. And then, as I will show you, I dig deep into each company to adjust any numbers that look a bit weird if you look over long term, and if they had any hiccups down the line, etc., to sort them out. First things first, what tools am I using in this video? Well, the first tool I'm using is Refinitiv, which is an equity screening tool, and a tool that's very, very complex and has a lot of data about stocks and other instruments. And I get it through work, which is why I'm using it, but I would never buy it as an individual. And there are many other tools that provide basically the same things at a much lower cost. The Swedish Investor is using a tool called Ticker, which is a screening tool, which is really, really good. And I will probably be using that in the future too. Then I'm using Excel. So basically just copying the data here and manipulating the data so it's easier to get a grasp of what I think about each company. I will go through that later. And of course, I'm using just a web browser so I can look at company-specific products, but also most of the data I'm using here can actually be found at the company's website. So, quarterly reports, annual reports, etc. have all this data. It's just that the screening tool makes it way easier to get a grasp on a market holistically instead of having to go to each company alone. So just be aware that these are not any special unique data points that you don't have access to, because you definitely do. So, how am I using the tools I'm using to get the potentially undervalued stocks in the Japanese stock market? Well, let's start with the screener from Refinitiv. This screener basically takes from the Refinitiv database that has basically every thing that's worth knowing about any stock in the world. Here on the left side, you can see the filters I'm using. And to go through them quickly, obviously sorting out, so I only have Japanese companies, excluding 4 sectors. And these sectors are energy, financials, utilities, and real estate, because they're either too cyclical, they use too much leverage to operate their business, or I just don't have enough expertise in them. Then I'm using a PE filter, so price earning filter, where I only look at companies between 5 and 25 PE. And that is because if a company is under 5, it's usually something fishy going on with it. I don't want to touch those companies. If it's over 25, you need a lot of expertise to justify such a high valuation. And then I should know about the company even without looking at any screener. So that's why. Lastly, these 3 filters are just so I don't have companies in here that has a negative operating income, because I don't want to deal with companies that has negative operating income, especially in these 3 years I've chosen, which are years that the stock market in Japan was doing relatively well. So the companies basically have only themselves to blame for having a negative operating income that year. And as you can see here, I found 1,473 companies that are potential, and I really emphasize potential, value investments. So let's go here. So I've taken out that data and put it in an Excel sheet. And this Excel sheet, the template of this Excel sheet comes from the Swedish Investor. And he is sharing this template. You can download it too. I will have a link in the description. And you can also watch his video on how he does the value investing with this screener in his YouTube channel. And so I've actually changed a lot of things on this screener and his initial template. And I will also link to my screener with all this data that you can get for free, just, to check out if you can find something that I won't in this video. And you can use it however you see please. But before looking at the specific stocks, I want to go through these 4 columns. And these 4 columns are based on this. So growth, return on invested capital, EV/EBIT, and insider activity. Basically the 4 most important things for Joel Greenblatt's magic formula. And with the help of the Swedish Investor, I have basically made a percentile ranking of each company that you can see here. And what it means is that, for example, the growth score means that the growth of this company is better than 73% of all companies on this list. And this company in question is Toyota. So I've actually sorted the companies here by market cap. And it goes for ROIC, so return on invested capital, is better than 44% of companies. So, average for the list. EV/EBIT score, basically how if the company is overvalued or undervalued, it's better than 8% of all companies. So basically it's higher valued than 92% of all companies on the list. And then insider score, this I might add while looking at each company separately, but I haven't found specific data points of insider trading for any companies yet. So this one is 0 on all companies so far. And when we summarize each of these scores, we get a total score that is, as I said before, based on 20% growth, 20% ROIC, 40% EV/EBIT, and 20% insider. And then we get a total score which basically ranks the companies of which company is best to worst with these factors. And so if we sort from that, we can see that right now, the best company of all quantitatively is Naigai Transline. And basically what I'm going to do from the highest ranked company and downwards, I think we're going to stop at 10 or 5, we'll see. I'm going to take these factors and see if the company fulfills all these factors. And if it doesn't, it will get a 1 on any of these things. And then it's out. So let me just show you. If I say, for example, too much debt, 1, right? Then the total score will automatically become 0. So it's out of the calculations. And this is the qualitative part. So basically here, I will look at companies individually to see if they fulfill each of these criteria. And that's what this video is going to be about. Well, let's start with the screener from Refinitiv Aecon. This screener basically takes from the Refinitiv Aecon database that has basically everything that's worth knowing about any stock in the world. Here on the left side, you can see the filters I'm using. And to go through them quickly, obviously sorting out, so I only have Japanese companies, excluding 4 sectors. And these sectors are energy, financials, utilities, and real estate. Because they're either too cyclical, they use too much leverage to operate their business, or I just don't have enough expertise in them. Then I'm using a PE filter, so price earning filter, where I only look at companies between 5 and 25 PE. And that is because if a company is under 5, it's usually something fishy going on with it. I don't want to touch those companies. If it's over 25, you need a lot of expertise to justify such a high valuation. And then I should know about the company even without looking at any screener. So that's why. Lastly, these 3 filters are just so I don't have companies in here that has a negative operating income, because I don't want to deal with companies that has negative operating income, especially in these 3 years I've chosen, which are years that the stock market in Japan was doing relatively well. And as you can see here, I found 1,473 companies that are potential, and I really emphasize potential, value investments. So I've taken out that data and put it in an Excel sheet. And this Excel sheet, the template of this Excel sheet comes from the Swedish Investor. And he is sharing this template. You can download it too. I will have a link in the description. And you can also watch his video on how he does the value investing with this screener in his YouTube channel. But before looking at the specific stocks, I want to go through these 4 columns. And these 4 columns are based on this. So growth, return on invested capital, EV/EBIT, and insider activity. Basically the 4 most important things for Joel Greenblatt's magic formula. And when we summarize each of these scores, we get a total score that is, as I said before, based on 20% growth, 20% ROIC, 40% EV/EBIT, and 20% insider. And then we get a total score, which basically ranks the companies of which company is best to worst with these factors. And so if we sort from that, we can see that right now, the best company of all quantitatively is Naigai Transline. I'm going to take these factors and see if the company fulfills all these factors. And if it doesn't, it will get a 1 on any of these things, and then it's out. So let me just show you. If I say, for example, too much debt, 1, right? Then the total score will automatically become 0. So it's out of the calculations. And this is the qualitative part. It's time for stock picking. So let's go to Naigai Transline and check if the company is truly undervalued. So the first thing we want to do is we want to check unreliable earnings. And we also want to adjust the total revenue and total operating margin right now to a number that we can justify even for the future. Let me show you what I mean. So if you go here to financials, income statements. So the revenue overall is the first thing we're going to watch. The latest full year they have reported is 2022. So we're still waiting for the 2023 report. Should probably come out in a couple of days. But for now, let's check the review numbers we have. And as you can see, it's been quite stable before, and then boof, it went up a lot. And that is likely because of the shipping company, Marine Freight and Logistics. And so the squeeze during COVID and after COVID, the supply chain squeeze we saw, made a lot of shipping companies have unreliably high profits. And this is likely what we see. And so we want to remove that one-time event. So how do I do that? Well, I do it quite manually. So I put it here, and these are the 10 years. Then we check the average, which is 26. And you wonder, why is it 26? Well, if you look here, it's actually scaled in billions. So 47 billions is the profits revenue this year. But what I think is more like what it should be is 26. So if we go back here, we change this and look at that. And then we will look at, the operating margin. Where can we find that? Key metrics. So if you look here again, you see operating margin was very high due to the COVID squeeze. And it was very stable from 2014 to 2020, around 5,374. Okay, yeah. So I think that's more than natural than these. So actually what I'm going to do is I'm going to take the numbers here, copy them, and I'm going to put them in this calc sheet. Remove the previous numbers. Ooh, looks like the black part here, whatever. And then we're going to see the average here is 5.69%. So I think that's way more representative of the actual operating margin company will have in the future. So let's change this to 5.6%. And now you can see that the total score is way lower than it was before. We don't even need to look at anything else to know that, yeah, this is, well, it's out. So now if we resort it here, see, it's gone from the list. So on paper, value commerce looks quite interesting. It doesn't only look good on the screener. It looks interesting when we look at the valuation compared to people's estimates, and its key ratios look very good. And now I want to show you what I do next when I deep dive into the company's qualitative aspects. This is a short video, so I'm not going to go full in. That would take many hours, but this is the baseline of what I do. First, I actually like to skip out from my regular screener and go to a website called Buffett Code. It's a Japanese website, it's free, and it's super good at finding value investing ratios. And here, the data I usually can't get from Refinitiv is data like let me translate to English. So this is the owners. And okay, so 51% of all shares are owned by ZHD Intermediate Holdings. I've heard about this company, and yes, they own another company called Zozotown, which is one of Japan's biggest clothes sites. Think of ASOS, for example, from the UK. That's exactly an equivalent of this company. Anyways, okay, so they own Value Commerce. That's interesting. That means, there's a big owner with a lot of money. So that's definitely not a negative. If we go down the list, there's a bunch of institutional investors. These are definitely institutional investors, probably buying, like a Japan fund or whatever, or a Japan index fund. You definitely see these guys high up. So, I mean, that's these. That means the company is usually quite big. Neither good nor bad, I'd say. Then I like to go here, which is actually showing the people that run the company and how much ownership they have. So here we have the CEO, quite young for Japanese standards, Hitoshi Kagawa. Here you can see his whole history. Looks quite normal. He's not a new guy. He's been there for some time. Yeah, that's pretty good. Okay, number of shares held, so 27. Let's see how many shares that is. So one stock is that price. This is the amount of money he has in yen. Let's do it to US dollar. Japanese. Oh, yeah, down to 2. Perfect. Yes, exactly. That's very little. $200,000 as the CEO. that is not a good sign. That's the first warning sign, right? It's okay. So now I like to go straight to the horse's mouth. So Value Commerce, Investor Relations. Here we can go in, and they actually have a English Investor Relations, so much easier to show on video. But they released their earnings report very recently. And so we can look at their presentation earnings reports to get a more detailed view of what the company thinks about itself. So you can see overall, operating income and net income exceeded the full year forecast, although they were significantly lower than the previous year. So if you remember before, previous year might have been COVID doping or something, but it looked very high. So not necessarily a warning sign, but as you can see here, it's much lower than last year. And here, some losses related to Dynatech. I would obviously need to check that out if I was going deep on this company. Here, we need the comments. This is what really matters in this report. So they say the operating income here is lower than last year. And these are the reasons. So changes to advertisement placement policies of some advertisers. So that's a bit of a warning sign already there. Impact of increased use of new advertising products from stores promoted by Yahoo. Yahoo is very big in Japan, by the way. And changes in campaign implementation policy. Okay, forecasts. This is also very important, because this is basically what the leadership thinks their business is going to do in the future. And that really determines the stock price in the short term. Here, though, 2024, so this year just started, right? So sluggish growth due to intensified competition. So that's a huge warning sign right there. So they themselves forecast that competition will grow. We'll likely see a lower return on invested capital, etc. And increasing strategic costs, mainly labor costs. Makes sense, labor costs are going up. Strategic costs increased. B-space, withdrawal from some contracted operations. That's not great. Let me just check out, what is B-space? So this is their sales platform. Will solve all your problems, yes. So they're saying they're actually losing customers. That is a big warning sign, right? Withdraw from some contracted operations. So that means competition is definitely heating up in this space, which they believe will cost them a lot. Anyways, just from seeing this report for this year, it already makes me feel like this company might not be worth analyzing further. They are themselves saying the competition is heating up. Their competitive advantage is likely going down. They are forecasting lower profits than this 2023, which was already way lower than 2022. It looks like, we call it a melting ice cube. Like, it's just the profits get smaller and smaller year over year. I would look more into this, but I'd say that this is a big sign that this company might not be worth the numbers on paper. So this is what you do. This is how you find undervalued stocks in Japan, or anywhere for that matter. And as you can see, this is a rigorous process, and it takes way longer than what I showed you now. This is really just the start. After you actually found a company that's more interesting than Value Commerce, you have to dig deeper, look at many reports, etc. Look at news around the company, and just in general, get a feel for the company before investing real money. But here, sadly, Value Commerce looked less interesting than I was hoping, hopefully, in the beginning. But I think that was a great lesson in learning that things are not always as they seem. You can find a great company on paper, but that can be because of an anomaly in how much revenue they made that year, or that they are doing so well but valued so lowly because everyone knows that the business is going to shrink from now on. These are things you can only learn by really studying the company. So please, if you even taken away anything from this video, do the qualitative research too. Look at all the news, look at their own reports, look at things they're saying about themselves and what others are saying about them. Test their product if you can, go deep, try to understand the business, because that's the only way to make a really good investment. I will, as I said before, link everything in this video so you can use the things I have, the data I have. Of course, it's going to be a bit outdated when I release this video, but you can still use it to learn, and you can find all the data from so many places. I mentioned Ticker, but there's so many other solutions out there. Finbox or Bloomberg terminals if you're really rich. Anything goes and anything is necessary for good value investing. Thank you so much.